Hello and welcome to the OFIF virtual panel on Beyond Libor. Thank you for joining us today. So today we have our distinct panelists from CSAN, Bank of Thailand, as well as EY. And John will be our moderator for today. John is our CEO at OFIF. And so just a quick housekeeping rules. This meeting will be on the record. So if you have any questions, we welcome you to send them into the chat box instead of the questions tab so that everyone have a view on that. And we will be able to pass that on to the panelists so that they can answer them. So without further ado, I would like to hand over this to John to introduce your panelists.
Thank you very much, Angelia. Good afternoon, everyone. Good morning, those of you listening in Europe. Welcome to this session on the replacements for Libor, important and complicated area. We'll get going in just a moment, but let me introduce first our panelists for today. We're delighted to have with us Aziz Durrani, Senior Financial Sector Specialist at the CSAN Centre. Aziz has extensive experience in banking and finance and in setting, enforcing and providing training on regulatory policies and standards, including to central banks and regulatory authorities. We do indeed have a central bank with us on the panel in the form of the Bank of Thailand with us today, Darani Seju, who is Senior Director at the Financial Markets Department, where she oversees monetary policy implementation and operations, Forex policy and intervention strategy, central banks, balance sheet issues, as well as market analysis and developments. Big and important job. We also have with us Simon Woods from EY, who is, among other responsibilities, the Global Financial Services IBOR lead. I'd like to invite you each briefly to talk about what you're currently working on in this field. Starting with you, Aziz, and then we'll go around and then on into the questions. So over to you, Aziz. Tell us a little bit about what you're doing at the moment on IBOR.
Yeah, so the CSAN Centre is it's a non-profit organisation, and it's owned by 19 central banks in the region, and we have another 16 associate members and observers. So about 35 central banks and kind of regulatory authorities are included in that. And our role is essentially to provide kind of risk advice, thought leadership, capacity building, training, and research in the various activities of central banking. So my particular focus is around banking supervision, financial stability, and so on. And so obviously Libor forms a large part of that work. And so, we've been trying to increase the pressure. I think one thing we can probably say, and my observation is that, whilst in kind of the UK and the US and also, of course, Europe, there's been a lot of transition already. Asia has been lagging behind, and certainly because of the current COVID situation, that's kind of further put a spanner in the works. So there's some positive developments certainly with for example, Singapore and others moving on to it, but I think there's still a lot more to be done across the region. So really, my focus is just to kind of drive that development as much as possible and ensure we can, get to a steady state by next year before the deadlines run out.
Super, thank you, Aziz. Very helpful introduction. Over to you, Simon. What is EY working on here? You're responsible for leading this area. EY, how does that take shape?
Thanks, John, and good morning and good afternoon, everyone. Yes, I have the joy of looking after this globally for EY, and we've been working on this now for it feels like for at least 2 or 3 years. And I have the advantage of sitting in Switzerland, with the world's leading IBOR transition country. So in Switzerland, you can now get SARON mortgages. So SARON is the new rate. So the first mortgages were launched about months ago in Switzerland. We now see the lending market adopting SARON as well. So not just the large corporates, but also the SME market. So I think the and as he sort of referred to this, is the pace of transition varies very much by currency, not by country, but by currency. So I would say that Swiss francs are probably the currency, and it has the advantage of being quite a small the derivatives kits, the lending markets, etc. See the sort of sterling and US dollar probably in that order, being then quick at the Asian currencies, as you say, Singapore and Hong Kong is focusing on that. And I think the sort of that pacing then gets you to a question around, first of all, what's my strategy for Libor transition? Is it a compliance only, or do I want to make this more transformational? Because it does touch every bit of a bank or a financial institution, from your customers to your accounting to your risk valuation models, contracts. So it's pervasive. So we've been spending a lot of time helping our clients think through their strategies and their plan, because this takes quite a long time to address. And I guess where the activity is very much around repapering strategy. So how do I embed the new language in my contracts, and how do I communicate to my clients? And thinking around how do I do that in a way which is fair to my customers, particularly where potentially valuations may shift. So the whole customer outreach is very big. And I think the other hot topic at the moment is around disclosure, particularly for IFRS. So under IFRS, you will need to disclose the extent of your book of Libor instruments, and those need to be audited. So that typically that exposure reporting is managed information is not robust. So we're seeing a lot of focus both from regulators but also other participants around those disclosures, and that the back book of Libor is then discontinued and run down. Those were the two major topics, but there's a lot of complexity in it, John.
It sounds like it. So as you say, benchmarks reach into every corner of the financial markets. Not just a matter of thinking about the day-to-day trading instruments, but contracts and contracts upon contracts, derivatives, and so on. It's a very, very complicated thing to change or unwind, and we'll explore that. Darren, you're actually involved in that process in Thailand, and I thought it'd be nice to hear from you what it looks like, in a sense, at the coalface to change a benchmark, because that's what you're doing at the Bank of Thailand. So tell us a little bit about the work you're doing there.
Yes, thank you, John. Thank you for your kind introduction, and thank you for inviting me to be a part of this panel. I'm delighted to share our developments in the Libor transition. Just to paint the picture, so as you said, we are the regulators, and now main job, central banker main job is to ensure that the market functioning, the market transition to the new rates or away from Libor is as smooth as possible and have no impact on financial stability or market functioning. So just to give you some backgrounds to how Libor is quite important in Thai market. Libor is used not only in like corporate loans, in referencing the foreign currency loans, it's also part of the very popular interest rate benchmark in Thailand, which is a FX swap implied rate called Thai baht fix. So that Libor is a component of that, and that is used in a lot of contracts. As of last year, we have around 50,000 contracts outstanding, and the value of these contracts are quite substantial. The corporate loans and derivative referencing Libor accounted for about 350 billion USD. And the corporate loans and derivative referencing Thai baht fix actually almost double that amount. It's 610 billion USD. So that's a big issue, and we need to make sure that if Libor ceases to exist, then we need something to be in place. So for the last 2 years, we have been working a lot with the industry, both the Thai Banking Association and the Association of International Banks, and to ensure that this transition will be going through smoothly. Even 2 years before, as Simon was saying, that it is a complex issue. A lot of things need to go into it. So we actually have a steering committee and split our working group into 3 sub-working groups, which the one working group will be working mainly on contract amendment, on the legacy contract amendment, because that is a lot of complexity in there and involve a lot of clients and corporates that need to understand the discontinuation of LIBOR and its impact on them, right? The other thing is what would be the other working stream is what would come in place of Thai baht fix. So we need to develop the rates that would be replacing Thai baht fix, which is basically the fallback Thai baht fix. And then we also aspire to develop the new alternative reference rate, the short-term reference rate. And the other thing is that I think EY and many others companies working a lot with our banks in Thailand is to make sure that banks are prepared for this transition, both in terms of IT, you know, the technology, the system, the trading system, settlement system, accounting, everything else. So we view ourselves as a, you know, a coordinator providing the necessary ingredients for the transition to be very smooth. I can go into detail more, but I'm not sure how much time I have.
And we will, Darren. I think that's very useful. I just want to ask a quick question before we move on. In your project management, is there a problem that you discovered that you hadn't foreseen so far in the transition, and what would the biggest one be? What was the unanticipated component where you found LIBOR embedded in something that you hadn't thought about when you started?
Luckily, nothing unanticipated. A lot of it are anticipated, but I think if I can tell you, John, it's more of a arduous task than we thought. Let's put it that way, because it involves a lot of, you know, like for example, we're trying to set standards, the new standard for the fallback Thai baht fix for the market convention, because there are so many different conventions, even in the market right now, even in some of the developed market in the DM countries, there are also many different conventions. So to try to arrive at a convention that's suitable for Thailand, it's taking a long time. But luckily that we didn't see any exposure that we didn't know before. At least we know, but we just need to manage them efficiently.
Okay, that's interesting. We'll come on to the fragmentation point later. I do think that of course is a big risk of getting rid of a common standard and replacing with a proliferation of others, and we'll come back to that. I think it's very important as markets are dependent significantly on liquidity to operate efficiently. Aziz, I'd like to just go back a few steps and briefly remind ourselves what went wrong with LIBOR, and all sorts of things went wrong with it. It was kind of surprising it survived so long in retrospect. But tell us the story very briefly of why it didn't work, conflicts of interest in the process of making a benchmark in illiquid markets and all the rest of it.
Sure, exactly. Yeah, I think, I mean, that broadly summarizes it. It was really the global crisis, financial crisis in 2008, that really exposed some of the crucial limitations that were inherent within LIBOR. I think the main one that everyone will be familiar with was its susceptibility to manipulation, and the whole LIBOR rate setting system became tainted by rate rigging scandals, where kind of the panel bank submissions you know, had been either inaccurate or manipulated to project market strength and for other kind of purposes. And in fact, there's, you know, evidence that had been going on since the early 90s. So it was a long-term thing that had been happening. It led to a loss of market trust, criminal prosecutions, billions of dollars in fines, and settlements having to be paid. And you know, even from the regulatory side, there was you know, there was this allegation and some evidence coming up. The Bank of England had also, you know, asked the Barclays to show a lower lending rate during the peak of the crisis, which, you know, you could argue that was needed to maintain that stability in the system. But again, it kind of shows its openness to that kind of thing. And then, as you're saying, there's also the illiquidity of the underlying market. A lot of the transactions were kind of short-term wholesale funding markets, which have significantly fallen over time. and then financial institutions have become more reluctant to lend on an unsecured basis for kind of longer than overnight. And then the kind of low volume of transactions increases that vulnerability to the short-term market illiquidity and the amplification of price moves, which again is a source of serious systemic risk. And so effectively, there was this challenge to LIBOR as a risk-free rate, and the argument is that financial transactions are better suited to reference rates that are closer to risk-free, and so that's really what this is all about. And I think, just to bring it back, part of the issue in the Asia region is, we didn't have this kind of this manipulation here, and the rate setting system had been a lot more robustly overseen by kind of regulators and central banks and so on. And so that's part of why people are saying, well, we don't really, what's wrong with the box in our country? It's still working, albeit the other global benchmarks are changing. So that's partially maybe an explanation of why things have been a bit slower to take off in this region versus the areas where there was that manipulation.
And we'll come on to how on earth these cats can be herded later. It does seem to be important that they are. Simon, so we've heard what went wrong with LIBOR. In retrospect, it's quite an odd an archaic way to create a market reference rate. What design features will we find for the replacements that get rid of those problems? And will doing so create new ones? I mean, there are all sorts of problems, of course, in accurately marking to market, particularly in downturns, as we've just heard.
Yeah, so I mean, I think the sort of what was wrong with LIBOR is a great question. I mean, clearly there are flaws, and I think certainly the messaging coming out from the Bank of England and the Fed has been the sort of the manipulation questions have been solved, but it's still a sort of expert judgment rate rather than a transactable rate. So I think the desire has been to create something based on transactions. Now, that assumes that there are transactions in the new rate, which, and this is one of the catch-22s of the whole transition, is that without there being a new rate to transact in, there will be no liquidity in that new rate. And therefore, people are going to be very reluctant to switch because they say, well, we're moving from a highly liquid, we know how it works, convention LIBOR to this new rate. And on the other hand, the market and the regulators are encouraging the market to move to these new rates. And there will be a tipping point, and we've seen that in Switzerland again, where SARON is now much more liquid than Swiss franc LIBOR. But this is all relative. I mean, neither of them are particularly liquid. So the challenge of establishing that new rate are multiple, actually. One is this sort of adoption point, and this is one of the real challenge in the US is whether SOFR, which is the official rate, is the right rate, and mainly the debate there is around the credit spread. So I think to Aziz's point, one of the moves from LIBOR to the new rates is to remove that credit spread element. And I think it's worth having a discussion around that. But then the other big challenge is around the sort of the interest rate convention. So LIBOR, generally speaking, is a forward-looking rate, whether it be 1 month, 3 months, 6 months, 12 months, whereas the new rates are overnight rates. And so one of the big debates, and in Switzerland, I think we had 11 different options around market convention, is how to create a sort of certainty for borrowers. So in Switzerland, we've just ended up with compounded in arrears. So it's effectively a daily in arrears compounding over a 3 month or a 6 month term, which has the advantage of being highly market consistent. The disadvantage is that certainty that LIBOR gave around the forward fixing has disappeared. So there remains a lot of debate, particularly in the loan markets and in retail markets, around how do we need to create a forward-looking rate, and if so, how do we do that without introducing that complexity that is inherent in new rates, but also expert judgment, which we've tried to get rid of in LIBOR in the first place. So I think the interest rate convention debate is certainly not over. It has been hugely complicated, and I think the advantage of LIBOR is everybody knew how it worked. It may have been imperfect, but it was a known imperfection. whereas we're in the new world and we're reinventing the wheel in certain cases, and different currencies are coming up with different conventions. We're also seeing that in product sets. So derivatives may have different interest rate conventions to loans, to syndicated loans, to, I don't know, retail loans. So what was quite a unified market where you could hedge and have a degree of consistency around convention is actually fragmenting as a result of the change. And I think
that sounds like a golden opportunity for all sorts of arbitrage traders. But perhaps we can come back to that. Just on the mechanics of collecting and calculating the rate. Libor was collected by the British Bankers Association, and as I say, in retrospect, it seems incredibly arcane, albeit it worked by being a common reference point worldwide, as you say. How are these new rates, that the benchmark rates that we're now getting, how are they compiled? Who compiles them? Who governs the compilation, typically?
Is that for me as well, John?
Yeah. To you, Simon, I'm then going to ask specifically, Darren, how it works in Thailand.
So one of the, and again, it's not entirely consistent globally, but there has been a shift from the industry to the central banks. So there's sort of two points here. One is that shift from expert judgment, so the panel, to transacted data. So this is real data, live data, in the same way that you can look at, I don't know, the FTSE or the Dow or any stock price. So it's transacted data, but increasingly the central bank is acting as the benchmark governor rather than it being a third party, and that has removed some of the challenges. Interestingly, I've spoken to a couple of central banks who do not want to take the responsibility on because they're worried about downside risk, which is sort of ironic in some ways. But I think that there is very much a shift to this being a more official rate rather than an industry rate, if that makes sense.
Darren, tell us about how your reference rate is compiled. Where does the data come from? Who checks it? How is it regulated? How is it distributed? Tell us a little bit about that.
Well, that's exactly what we do, the central bank. So we're taking over everything basically. But for the new reference rate that we're trying to develop, as I said, that we look at the market that is most liquid, right? And it turns out that the private repo market, the interbank private repo market, which is a secure market, is actually very active. The volume, the overnight transaction volume is around, daily average is 4 to 5 billion US dollar. So we think that would be a suitable new reference rate that we're trying to develop. So once we decided on that, we actually already published what we call Thai baht overnight repurchase rate. The acronym is THOR, THOR. Nothing to do with the Greek, THOR. But it turns out, THOR. And we actually the calculator. We are the administrator, but we outsource the calculator to the SRO, the Thai BMA, Thai Bond Market Association, which is our SRO in Thailand. So basically, we are, the central bank is actually behind this rate, and it comes from a transacted rate. So hopefully there would be no dispute of being manipulated easily. And we use an overnight tenor, which is the most liquid. And this one is also support our monetary policy transmission mechanism, because our policy rate is actually based on 1 day overnight repo rate, also the policy rate. So we think this is a benchmark that it would be more suitable, that we would like everyone to move to. And we have been trying to do that by providing all the tools that needed. We started in April of this year. We already published THOR average, and we provide many things on our website, on our own website, which is the THOR index, THOR average, the calculator of THOR, everything that you can think of, so that the market participant have the tools to use to be, to offer products or to understand this product linking to the new interest rate benchmark.
Okay, thank you, Darren. Can I just go back one step in the food chain? Where does the bond association get the transaction data from? Is that given to them by commercial banks?
Yes. All the market participants, because they actually the bond market association already have the outright transaction, the bond outright transaction that the market participant need to report to them within 30 minutes of trading.
Right.
So you know, so that infrastructure has already been in place.
Okay.
Right, including the repo transaction, it's already been in place. So.
Okay, good, super. Thank you very much, Darren. Aziz, I just want to go, before we move forward into how we manage this issue of proliferating rates, and then whether we lose on market efficiency and liquidity because of the proliferation of standards. One of the theoretically interesting episodes we were just talking about, when the Bank of England allegedly asked for Libor to be misquoted in order to effectively to stop a run on the banks in the certainly in the bank finance market for bonds. Could we see theoretically in a future downturn that actually very accurate pricing might be unhelpful again? I know that it was a once in a 100-year event, but sometimes marking to market very accurately exacerbates problems. I know that's not really our concern here, but it is an interesting point.
No, that's a great point. And you say it's a once in a 100-year event, but look, we're already having the COVID crisis, right? And in March, when everything kind of started going sour, there was a lot of concerns there. Now, obviously, this wasn't caused by the banks, but there's, the jury's still out on actually what's the ongoing effect on the banking sector, especially once the real recession kicks in. We've seen, from the ECB and the systemic risk boards kind of just saying we need to be prepared for banks' non-performing portfolios and banks falling over and so on. So it's still a risk, and I think you're right. There is a question now that we potentially lost that element that in extreme market panics, sometimes you do need to be able to step in and at least give that assurance that things are under control, because a lot of it is about belief and so on. I guess there is some built-in kind of safeguards. Simon, you were just talking about the different how we figure out work out from the overnight rate to a 3-month or 6-month or whatever. So if we're using past historical data and compounding that, well, then that will smooth out some of those extreme spikes, which you can argue both ways. One is kind of not accurately representing what the current risk price is, but two, it's giving you some time to adopt that. So potentially there is some of that, but I think there is that risk as well.
Okay, Simon, we were just hearing from Darren that the Bank of Thailand collects live market data which already existed and compiles it into the new reference rates. What do we do where there isn't any transaction data? How do we set a reference rate for an illiquid market?
That's back to sort of almost your expert judgment and sort of trying to set Libor when there were no transactions. And I think that was one of Andrew Bailey's critiques of Libor was that quite often there was no data points and nothing was traded because it was a notional trade. So I think that the one firm positive thing is that there are transactions. I mean, there are normally linkages to other rates. So as Darren was saying, is that you start off with the interbank repo rate, which is the most liquid one in Thailand, and I'm impressed by how much volume is going through that compared to some of what we're seeing in Switzerland, where the volumes are still pretty low. But the good thing, they are substantive and substantiable, if that makes sense. So we can actually see them. I think the challenge is not the base rate. I think the challenge has been how do you build out the not complexity, but the choice of products away from those that very simple base rate. So the exciting thing about Libor from a financial markets perspective is you start with, let's say, a 3-month or 6-month rate, ended up with swaps. You had options, you had swaptions. There are a whole load of basis swaps, all sorts of things built off that one concept. And one of the challenges we're seeing now is that ecosystem of ancillary rates, from the overnight rate to a term rate to options, is taking time to evolve. And I think that is one of the real thorny points, especially as you have historical transactions linked to Libor, which don't naturally map over to the new rates, or where the valuations are quite materially different. And that's not a trading difference, it's a more architectural difference around how the rates compound. So there are some significant basis differences and values potentially transferred from one counterparty to another through the switch. And that clearly is you talked about arbitrage earlier, but that normally a market should be efficient and there should be a clearing price. But there are some structural value shifts, which oddly enough, well, not oddly enough, but are less impactful on banks who tend to be running a flat book, but end users, so whether they be borrowers or lenders, may find that there's sort of value moving against them. So I think the issue is not so much around substantiating the base rate, it's building out the curve, it's building out the other products, and then thinking around how do you manage that transition and to do that in a fair manner.
Okay, we'll come on to the implementation of the transition in a moment. Aziz, take us on a tour of how regulators are looking at this and to what extent they're talking to one another. Are we going to, in a sense, allow the market to decide its own rate? We'll have a competitive process where the one that generates the most liquidity becomes the global standard, or will regulators help decide that? How's it going to work?
Yeah, so I think, obviously you'll have the kind of the SONIA for pound sterling and so forth for USD, and so for the major currencies, there's clearly the main reference rates that will be used. But then I think particularly in Asia, different countries are taking a different approach. So it very much depends on that, and it's up to them to decide for their own domestic currency. So Darren's obviously been talking about the approach that's happening in Thailand. Another country kind of leading on this is Singapore. They've kind of implemented their own move. They've kind of they've highlighted which way things are going to be going. So the domestic rate of SIBOR and SOR will move to SORA, and they're kind of setting the standard because they've a couple of months ago they auctioned 500 million of Singapore dollars 6-month floating rate notes with the spread that was compounded over that SORA rate, the Singapore overnight rate average. So they're trying to bring that into the mainstream, and the banks are being encouraged to go along the same lines and so on. Other countries are taking a different approach. So in China, the People's Bank of China has released a white paper which sets out its plans on the benchmark rate reform and what banks need to do before the 2021 deadline, and so to allow things to function. But there's no benchmark replacement rate, so there's no plans that the PBOC has to phase out the use of the Shanghai Interbank Offered Rate. Similarly, in Hong Kong, there is a move from HIBOR to SOFR, and again, the HKMA is encouraging banks to kind of meet that milestone and go along it. But equally, banks have started issuing loans using that SOFR rate, but HKMA is not going to discontinue HIBOR either. So there's a mixture. Again, all of these countries have a lot of domestic lending. India as well has a lot of external borrowing in dollars that was linked to MIFOR, which is derived from USD LIBOR. And again, the RBI, the Reserve Bank of India, has mandated that banks transition to the external benchmark, but they can choose from either a policy repo rate, T-bill rate, or other money market benchmarks. So although this is good, it kind of, again, there's an argument that the policy rate that they're going to doesn't reflect evolving market conditions as well. There's a similar kind of thing, across Indonesia. Japan as well is moving to toner, and it's all being developed. But I think the pressure isn't there. And I think, just kind of to summarize it, earlier this year, the Asia Pacific Loan Market Association had kind of surveyed its members, and about 56% thought that the syndicated lending market wouldn't be able to adapt to coming off LIBOR in time for the December 2021 deadline. So I think there are definitely concerns there that we need to be aware of.
Okay, thanks, Aziz. I'd like to turn to you on this one, Simon. Aziz seems to have just described a rapid process of deglobalization in these reference rates. What do you think will happen? Do you think that you'll end up with regional gravity, with the biggest economies creating the rate for the locality? Will we have a global standard? How will regulators get them to cooperate? What are you expecting to happen here?
So, I mean, I think I would start off with my comment around that you need to think around this by currency. So rather than country, think about currency. And I have to say that that having taken on this role, the amount of eyeballs I've come across is spectacular. There's, pretty much every currency has their own eyeball type of rate. And I think as currencies remain currencies, I think there will be a need for a reference rate. So I think that degree of proliferation is sort of inherent in the system. I think the slightly more difficult question to answer is if you look at, some currencies are definitely moving. So I think Switzerland, UK, it's pretty clear the direction of travel. You've then got a large block in the middle where there may be this sort of dual running approach that Izzy's described, where there's new rates, but the old rates haven't been switched off. And then I think the third or second probably biggest currency block in the world is the euro, which is not transitioning. So I think the risk is not so much the which rates per globally work, but you have this sort of slightly weird world of some people have completely transitioned over and turned off the old rate. So say GBP. You've got some sort of dual running, which I think will happen in many currencies, particularly in the dollar market, because of some of it's just the hugest block of product. And then you've got the euro, which has announced no plans. Stephen Major of ESMA was saying, there's no imminent transition for the eurozone. So I think that's the complexity, is that you have even more rates. I mean, I think then I'm not the macroeconomist here, but I think that naturally liquidity will rates will become dominant around liquidity. So I think that will reflect trade flows and global policy.
I've had a very interesting question from the audience. I'll turn this to you as well, Simon. How will a new system like SOFR deal with volatility and repo rates, which can lead to crisis and less stability?
So it's a good question. It's an unknown, because we haven't, I mean, like always, we live life looking backwards in some ways. So we learn from crises, and we haven't had one yet, fortunately, in SOFR. But one of the big arguments at the moment, and it's particularly evident in the US dollar market, is this point around the credit spread. So a number of banks are saying that SOFR is not an appropriate rate for them. For two reasons. One is it's very skewed to the large international banks who have big repo operations. It's not that relevant to the regional banks or to smaller banks. But secondly, it takes, by moving from LIBOR, which is an unsecured rate with a credit spread, as Aziz was saying, to SOFR, which is a secured rate, it's a repo rate, you remove the credit spread out, and that's not an individual credit spread, it's a systematic credit spread. But that, despite all the problems with LIBOR, acted as a very big macro dampener for the banking system in the crisis. So as conditions worsen, your loan book reprices and your funding book reprices. So even though your funding cost goes up, you earn more income on the asset side. In a world where you don't have that systemic credit spread on the income side, you get an accelerated problem around stress, transmission of stress into bank balance sheets. So one of the big concerns is not so much the spiking of SOFR against policy rate, and there's some very strange technical factors around quarter ends around the US government's financing needs, which is impacting SOFR, but is whether this system is actually less stable now from a macro-prudential perspective than it was because of this dampener. Now, clearly, there's price contains different information. It's sort of sentiment, it's technical factors, supply and demand, and stress. But I think a lot of banks are arguing and lobbying hard at the moment that, whether it's called a Maribor or something like that, that it's important that there is a credit spread element built into the new rate exactly for this purpose, to create macro prudential stability in stress conditions. But we've got some very esteemed panelists with Aziz and Darren, who are the experts in these types of topics. So I'm sure they would have a view. And John, you're very modest yourself, so I know this is an area of expertise for you.
Well, Darren and Aziz, you're welcome to come in. I've got more questions coming actually, which suggest we're going to end up with the rule of unintended or perverse consequences with the Libor change, in that you introduce something which is potentially more vulnerable to rigging than the old system. And I'll come on to that in a minute. But Aziz, just on Simon's points just then.
No, I think it's definitely a risk, and that is something I think that does worry me. And as I was saying, we've got this potential issue of next year, as a large part of the book is being transitioned onto these new rates. It could occur at the very time when we are crystallizing part 2 of or part 3 of the COVID crisis, or something else blowing up in the markets, or central banks having to take additional QE action, or whatever the case may be, and could see a sudden spike in rates and so on. And so, through no fault of their own, as it were, suddenly customers are transitioning from Libor onto new rates and seeing massive increases and so on. So there's definitely a financial stability issue there, and I think we need to be discussing it more and looking at ways of trying to deal with the potential outcome of that. I don't think it's been given enough focus at the moment.
Darren, what do you think in terms of the vulnerability of the replacements to distortions? The process of getting rid of the distortions in Libor will introduce new potentials for distortion. What do you think about that?
Difficult question to answer, but first of all, we think that the new reference rate would be less distorted to rigging, because it's based on transactions, right? But of course, I take the point that the credit spread may not be embedded in that. But I have more question than answer, because this is the thing that we are discussing also, whether how do we pricing that accurately, and we don't want to create another the new thing. Like, for example, Simon was saying before that we need some forward-looking term rates, and that's also going to be based on something quoted or something even more vulnerable to rigging. And then we don't want that. We don't want to go back to the same problem. But we think, well, for now, with the new reference rate, we think the problem of vulnerability to rigging or doesn't exactly reflect the market credit conditions, hopefully it can be solved by some other ways, that we are not returning to the old problem that we have. But we haven't arrived at a solution yet.
Okay, that's very helpful. Thank you, Darren. Simon, I want to move on now to the technicalities around transition. A really good question has come in on this, which says spread adjustments following Libor transition would entail a loser and a winner. How do we ensure that customers are treated fairly, in the sense that banks do tend to pass on losses to customers rather than taking them in their books? So if the changing reference rate means a change in price, who pays?
It's a very complicated question. I mean, it's a good question and it's a very real issue. And as I said, most banks start off relatively flat. So having, despite the, and I say I'm skeptical that for banks, I just think they can't do the maths personally. But anyway, that's a different matter. Because because a basis point on trillions of notionals, with the duration here is a lot of money. So I think that it's one of the thorniest issues at the moment, particularly in the UK, because the UK market, as people may well know, has a lot of focus on fairness and treating customers fairly. So the conduct regulator, the FCA, is driving the transition much more than the prudential regulator, the PRA, and treating customers fairly is embedded in their approach. So one of the things that has been very hard for and has slowed the transition down has been managing this risk, because the banks are, I had one bank say to me a year ago, said like, we're damned if we do, if we damned if we don't, because if we, let's say, advise and we'll be deemed to advise our clients to transition early, and that was the wrong strategy in hindsight, and they've lost money, we're on the hook. Yet if we tell them to wait and see, and again that's proven to be wrong, we're short the option. So I think banks are very concerned around not actually what you may think it would be, which is actively passing losses on, but being held to own the risk that whatever any losses that come up are for the bank's account because of the regime. So one of the things we're spending a lot of time with our clients in the UK, and that's not just UK banks, but everybody in the UK system, is around this idea of how to communicate fairly, make choices very clear, articulate the risks, and to manage the conduct risk within this at the same time as thinking through the repapering strategy. So the question, and in some ways, the easiest way of dealing with this is for the old product to disappear and you to move into a new product. So there is no value transfer. So if I have let's say a 3-month loan, when that loan expires, I enter into a new loan, which is, let's say, SONIA linked. So there is no repricing risk or transfer risk, because at that point in time, I have a completely new product priced to market. The risk becomes more apparent if, let's say, I have a 5-year loan that is Libor linked, and then I'm put into a SONIA linked loan, and then I can say, well, either the spread or the convention or whatever it is made me worse off because of that decision. That becomes much more tricky. So I think amortization is most definitely your friend as a bank in this, because right, you can move people into the new rates. But also there, and to Aziz's point about dual tracking, there's also a lot of concern around are we able to go straight into that new product, or do we need to go to an intermediate step? We have a fallback rate, and then at a later stage we move people from fallbacks onto the new rates. So it's hugely complicated, and it very much also depends on who your customer is, their degree of sophistication, and how many products they have with you. So typically a bank will have let's say, a relationship with a customer. They'll have loans, they'll have derivatives, they may have some FX, and you need to manage all of that relationship rather than do it on a product by product basis. So this is a complex topic.
That is vast, I think. We've had some questions in, we'll come back to in a moment, about term structure, which relates to this issue of liquidity and new rates across the curve. Just exploring this issue of who pays. I mean, banks obviously have quite a lot on. The UK, as you know, they're not allowed to pay dividends at the moment. They're dealing with super low interest rates. They are about to be impaired, as you said earlier, potentially by NPLs from COVID. Is it a good time then to ask them to pay also for this transition? And does anyone know roughly what that might cost? That could be quite big sums, I'd have thought.
So certainly the programs are expensive, depending on the complexity of the business operations, because it's not just so I think there's two costs here. I think there's the sort of the OPEX side of this, which is effectively writing to my customers, changing my legal contracts, updating my systems, taking that through governance, having consultants or contractors or internal people. So that in itself is not a small bill, but it's not as big as other, whether it be Basel 4, CRD4, Basel 3 type things. But the bigger unquantifiable question is the cost, that compensation cost or the trading cost. And certainly from an EY perspective, we try and find out sort of where that may be. And it's very, very hard. We've written articles on valuation differences, and one of the interesting things is that the market, as markets stabilize and transition becomes more certain, the traded prices converge, as you might expect. So the arbitrage opportunity disappears as people expect the transition to happen and happen smoothly. However, when there are stresses in the system, so particularly we saw that in around March, April, though that value transfer or that value difference expands. It's a bit like the Libor spreads itself. So, and very much to Aziz's point, if the markets are stable when this happens, then this should actually be relatively value neutral because of convergence and the markets working efficiently. However, if transition happens at a time of stress, there's more likely to be value transfer, and it's hard to know where that is ex ante. I think that the one place where we do see it at the moment is derivatives, particularly complex derivatives, so swaptions, options, where there is not a volatility market or convexity market at the moment. And from what I'm understanding is that the banks are saying, well, if you have that type of product, you're almost by definition a big investor in it. Your eyes open type of risk. So there is a bit of debate.
Caveat emptor.
Exactly, in the pension fund and insurance sort of the professional investor market around the pricing and the transition of those complex derivatives.
Are you saying the pain will be evenly spread? I think that might be what you're saying.
I think I think there is definitely pain on potentially in the people who've got swaptions, and that will depend on the inherent, the way their positions are. So I suspect that there will be a value transfer from hedgers to the hedge, so the people who've taken out the hedges to the people who've provided the hedge.
Right. Yes, that's big and important result of changing a reference rate, I think. Aziz, we've had quite a bold and clear question from the audience, which I think is worth us considering. What is more important, one, financial stability, or two, preventing the rigging of the rate? Parentheses, perhaps the concept of the market finding a true price is erroneous. What do you think about that?
Yeah, I mean, it's a good point, and I can see kind of the questions coming in are, really kind of challenging some of the potential stability of these new reference rates, and
they really are,
and the downside. So, and I don't disagree with it, but look, the previous system was found to be rigged and not efficient. So it's not a question of kind of trying to go back to that, because it's not going to happen. We can't go back to something that we know is fundamentally flawed, albeit we can appreciate that perhaps we prefer being manipulated a little bit than face the real market risk. But the key question actually is the decisions that need to be taken by treasurers of companies and so on needs to be a bit more complex now, and take into account that we are dealing with this new benchmark, and it is coming in, and particularly over the next year or two when it's being transitioned into, and we're under a very difficult climate, that all needs to be fed into whether you opt for a fixed rate product or a longer period for the fixed rate, or how you want to do it to kind of avoid sudden changes which may occur through no fault of your own, but because of wider macroeconomic issues. But that is the real rate. That is what's happening in the world, and that's what a floating rate does incorporate. So it's kind of that's the risk that you're taking on if you're going for a floating rate. But I think there is definitely a financial stability issue that could come out of this.
Do you think, in a sense, this is a hypothetical question that is redundant because we are where we are, but do you think maybe this should have been left alone? Like rating agencies, after the crisis 10 years ago, people thought the rating system was flawed, and we all understand why. Same kind of issue, conflicts of interest, but in the end, regulators decided to leave it alone. It's too complicated to pull ratings out of the financial system. Do you think perhaps that should have been done with this? Just a quick hypothetical.
No, I mean, come on. People were manipulating this rate, making billions of dollars out of it, ripping off customers. It's completely wrong behavior. And to say that let's just leave it in place because it's too complicated to change it, kind of isn't the right thing, and would just everyone will start cheating on an even bigger scale. So we have to be realistic about that. But
fair enough. Would you agree, Simon, that it is worth what sounds to me like a considerable amount of upheaval in the financial system with unexpected costs for some people, and maybe not solving the things it's supposed to solve?
Yeah, I mean, we have the English expression, right? The proof of the pudding is in the eating. I think we're still baking on that case, whether it's worth it or not. But I think the other point, and Aziz, I think, made a good point, but also is just the availability of panel banks. So there's a real challenge that I think we are down to minimum quorum on the panels of Libor, and no bank in their right mind wants to go on the panel. So you sort of have a view of either if you're on the panel, it's your inheritance, but a bit of a burden, because most people would regard themselves as having risk and no upside given the regulatory and legal environment. But with banking consolidation or banking stress, I think there is a real worry that there won't be enough banks to be on the panel to set a reliable rate. And I think that, as much as the rigging, which can be fixed, so governance has been much more robust around. So I know a number of clients who have a complete Chinese wall between the people who submit their quotes and the people who can trade. So there's clear. So you can fix the conflict of interest point, but if there is bank consolidation and there's only 2 or 3 banks who want to set the rate, it becomes even worse. So right. I think moving to a transacted rate must be more long-term, a more robust approach. I think the challenge we have is we had a system which worked pretty well despite its flaws, and sometimes we like all of these changes, we forget what we had until you try and rebuild it. So I think that sort of process of rebuilding will take time. There will be challenges and problems, undoubtedly, but hopefully once we're out the other end, we will look back and say, well, maybe it was worth it.
Darren, I don't think it's fair of me to ask you if it's worth the hassle, so I'm not going to. I think the consensus on the panel that it is medium-term worth the pay. Just on the issue which has come up a couple of times in the questions, we've talked about numerous times, how do we solve this problem of creating liquidity across the curve, so you don't get, one, you incentivize people to participate in the new rates, and 2, you don't get undue distortions between the new and the old rate? How do we solve that?
Yeah. Oh, okay. I think it's as any new things to try to create liquidity and market participants to get involved in the new thing, to change their behavior, to change to the new convention. It requires a lot of efforts from every parties. And we, as a regulator, as a central bank, we're trying to provide, do everything that is possible to facilitate that process. And we see ourselves as, in one of our department is actually market development, right? So we see ourselves as a catalyst in terms of developing on this market. So we're doing a lot of things to try to nudge people to go to the new rates. At the same time, the old legacy contract, we need to make sure that it's smooth transition. So when Simon was saying earlier that about the switch over to the new rates or the switch over to the fallback rates, our strategy here is we will provide a fallback rate for the Thai baht fix temporarily. We're thinking about up to 3 years temporarily, so that to make sure that when the contract transfer, contract amendment happen, it's as value neutral as possible. In that sense, to take care of the conduct risk, because we want the banks to treat their clients fairly also. So we will provide a fallback Thai baht fix, and so this amount of time, this duration, say 2-3 years, we hope that the market for the new reference rate would take off, would have more liquidity. How do we do that? So as I said, we try to set the standards that is sort of our international standards, but as we've been talking, that it's quite fragmented at the moment, quite different between derivatives, between cash, between different cash products. So trying to make it as suitable for the Thai market as possible. And so we set the standard, we set the market condition, we try to provide the tools and introduce a new product. As part of our, just to answer to Simon earlier when you say that you're surprised by the amount of the liquidity, the liquidity in the private repo market. The reason for that is that we ourselves, as a central bank, we have a lot of excess liquidity in the market. We use the repo to mop up the liquidity in the market, also through a set of primary dealers. And that's why they necessitate the liquidity, the distribution of liquidity to other market participants. And which means that it helps to create the volume of the transaction volume in that segment. Right. So the liquidity is there. We just need the new products. We try to introduce a new product that referencing TOR, so that it can provide hedging instrument. It can provide the underlying transaction that people can hedge against. So starting next year, we issue BOT bonds and BOT bills quite regularly as part of our open market operations. We will issue the BOT floating rate notes against TOR. So, as a regulator, we think we can provide all these tools, all this product, all the, the needed pricing and calculations. And also the things that we do quite a lot is communication. Making sure all the market participants, be it banking, be it banks, insurance, corporates, all the clients, and everybody knows that they shouldn't have the new contract based on Libor or Thai baht fix anymore, and we encourage to move to the new products. So that's the only way that everybody has to take part in this market. That's the only way to create liquidity in the market. And let me just say that we have set the timeline, we have set the key milestones to, we would come out with a prohibition of the, new products, new cash product. You should not be referencing the legacy rates anymore. The Thai baht fix, the one that we're gonna try to go away, and we recommend moving away to the new product. So, it's gonna be a journey, it's gonna be a process, but
that's very useful. That's very interesting. Simon, we've heard there a wide range of carrot and stick measures there from the Thai Central Bank, including, if I've understood rightly, the bank itself creating liquidity in the new rates in cash markets. Do we expect to see that anywhere else? You can't really argue with a central bank if that's decided to make a market, as we know. It will.
I think there's 2 points here. I think one, and I would, I'm very impressed and continue to be impressed by Darren Lee and what you're doing. But I think that view of the central bank as an actor is definitely, with QE, negative interest rates coming, I think will become more apparent. So when I speak to the Swiss National Bank, they have a very large market operations as well, and I think a challenge for them and for everybody is that once you become a market player, it also becomes quite hard to become the referee and a big participant. So I think having the right governance within the central banks and the right sort of conflicts of interest there and separations will be important. And certainly the Swiss National Bank are very clear that they have a rate setting approach or a policy unit, and they have a trading unit, and those two things are quite separate. So I think we will see central banks become more activist. But I think the other one around carrot and stick is, the discussion around capital add-on. So we are seeing a lot more stick from the central banks around encouraging being a very British way of describing it, transition, and then adding, so I think we will see capital add-ons potentially for old rates coming through, and therefore it will be a lot more not only sort of discouraged but also expensive to be still maintaining a book of legacy products. So I think you will see those coming through, and certainly when I've spoken to a number of regulators, they are expecting to bring those proposals forward on that in the coming months.
Okay, that's very interesting and useful for everyone here, I think. Aziz, this is a very interesting theme for us, obviously OMFIF, and you convene central banks all the time, and they're being asked to do a lot, everything from ESG through to monetary financing in some places. They've got a huge job to do, also maintain levels of employment and protect the price of money. So it's got a long, and regulate banks. So they've got a lot to do. What do you think about this? I mean, since they are such big market participants at the moment, they might as well create liquidity in these new reference rates while they're at it.
Yeah, I mean, this is where the kind of the issue gets quite material, because I think it's kind of like we've seen the Fed intervening to keep up the stock market and prevent it collapsing, right? Once you start going down that path, where do you stop? And as soon as they kind of say, okay, we're going to pull back now, everything starts collapsing and so on. So I think there's a very delicate balance between supporting it during a period of transition and allowing that liquidity to be there and to find itself, but it needs to be able to operate, by the market and independently. Otherwise, you're going to have the same flaws coming into the system. I think my bigger worry is just coming back to what you were saying at the start. Given everything that's on the book of central banks at the moment, the recession, employment, ensuring the economy survives this pandemic, this is there's a risk that this takes a bit of a back seat, and clearly Dharani and all the other colleagues are doing a lot of work, but there's only so much capacity for players to take that on board. And so the worry is at what point does something trigger and get missed, or the rates suddenly shoot up and this creates a bigger problem next year. And just already, even before coming into COVID, we were quite behind in Asia in terms of where things were. And so I just think that we're already having to play that catch-up game, make sure the banks are, going down the path as expected, and the customers understand it. So it's already a challenge, and now it's going to be even more difficult in the current climate. So I think it's important to keep that pressure up.
We've had quite a few questions which essentially suggest the changes are specifically counterproductive. I just want to read one out, and then we'll move on to concretely what we expect to happen when in Asia, and finish up. Simon, I'll turn this one to you. Perhaps you've seen it in the chat box. We've seen a significant SOFR move subsequently over the end of last year when the daily repo rate hit 10%. This meant that both borrowers and lenders had significantly different returns for transactions. We talked about that earlier. Surely this means stability is weakened, as corporates in particular should be able to rely on floating rates, not potentially changing dramatically to the detriment of their funding budgeting. Any reference rate that can change on a day-to-day basis increases financial instability. Is the mark-to-market point we were discussing earlier. What do you think about that?
So, I think the comment is well made, because so this was the point I was referencing. So if you look at the SOFR spread, it tends to spike at quarter ends, which is a very technical issue around the US government funding program. And I think both end of December and the end of March, were both pretty significant spikes, but just for one day. So I think that is a known problem in the market, which will be cured by a few things. One is, as more liquidity flows through SOFR, that relative impact will be sort of lessened. But I think then, and Aziz made the point around it, on an averaging basis, a spike of whatever it is, 50 basis points on one day over a 3-month period, may become sort of less than a basis point. So I don't think it's a structural flaw. It's a feature, and I think that is one of these second order, third order effects that nobody had thought about. So I think as we understand the financial ecosystem better, as people switch over, there will be other things which pop out. But I think it's just then, if you know about these things, then you can manage around them. So undoubtedly there'll be other issues, and these things exist in the moment around, if you look at basis swaps, so you look at, many of the highly technical natures of the financial markets, there are certain parts of it which are extremely susceptible to peak flows, and and that's the nature of traded markets. You start understanding them and then planning around them. So I would sort of refute the criticism that creates financial instability. I think it's more of a technical effect rather than a systemic effect.
Okay.
But, I mean, Darren and these may have their views as well.
Fair point. We're shortly out of time, so I just wanted to concretely come back to what we expect to happen when specifically in Asia. We've heard Darren talking about the very complicated and well thought through program in Thailand, and as you say, Simon, with a series of second and third order effects already being worked on. Aziz, what do you expect to happen when broadly in Asia? Which rates do you think will prevail in the region? I'm going to ask you to make a prediction.
Well, no, I mean, I think we've got a set deadline of December 2021 when officially that benchmark will end. So I think the general guidance across the region is as Darren was saying, new loans should not be on that old benchmark anyway, but from either Q1 next year or H1 next year, there'll be a kind of more harder deadline. So I think that will push the transition in that stage, and then I don't think there's that competition in the same way, because it's those domestic rates were there before. It's just that previously they were based on Libor or some element of that, and going forward they'll be based on these reference rates. So that will still remain for the domestic markets, and then for the international we'll have the various new replacements. So I mean, yeah, Darren, you feel free to add anything.
Yeah, thank you, Darren. Just finishing up now, Darren. What do you expect? What do you see happening in Thailand, also neighbouring countries, and when? And do you think there'll be a dominant pan-regional rate that isn't Libor but something else? I want to tread carefully, but whether it will be a rate set by the PBOC, perhaps.
Okay.
I know that's tricky, but
okay. I will not try to answer the last bit of the question of your question, but we expect everything to be ready by the first half of next year. That's how we communicated to the market, that everything to be ready means we expect the contract amendments to be done. We expect their IT system, their operation, tax accounting, and everything. They should be ready to be offered the new product, the new product referencing the new reference rate by H2 next year. So everything should be ready by the first half. So H2 next year is as if we have already transitioned to the new rates, but so that this half year is sort of giving them some leeway, so that if anything's happened, some testing, some things, so that when the Libor cessation is actually occurring at the end of the year, then everything should already be very smooth. So we are expecting the first quarter of next year that banks should be able to do the new derivatives basing on the new reference rate, right? The new derivatives. For cash product, it's a little bit more complicated, so we expect it a quarter later, which means the first half. So everything should be ready by the first half. And I don't think there would be any dominant rates, because basically we think that most of the rates that are, as I said before, that some of our domestic rate is actually based on US dollar LIBOR, have an element of that. It's the FX swap implied, right? SOR, MIFOR, FIREF, and Thai baht fixed. So I think this would go away, right? Because we would do away with it. It's only provided temporary, and then it will be more or less the local condition that reflect the baht liquidity or the single dollar liquidity in the domestic market.
Okay, that's very helpful, Darren. Finally, with you, so what we've heard there is a renationalisation of rates there. I was somewhat asking whether we might have a pan-regional rate based in the region. Let's put it like that. It looks like that's not in prospect, or even the one based on the US. What would you expect to happen in Asia over the next 5 years on reference rates?
So I'm going to answer that in a slightly different way. I mean, I think one of the things we have seen is that there is an advantage in being early in adoption as a bank. So a number of banks have, banks have taken broadly 3 sort of strategies. One is sort of invest and lead. One has been sort of being in the pack, and the last strategy, I don't know if it's strategy, but has been sort of like slow follower, sort of just in time adoption, minimum compliance. And I think what we've seen, and it's a really interesting point, is that those banks who are in that first cohort are picking up market share and outperforming the others. So there is a distinct competitive advantage in being first with a product in the market, because not only are you gaining market share in that product, but you're starting to see the flows and understanding the new the trading ecosystem. So I think what we will see is that it's not so much a question around rates, because I think to my point, and I agree, I think with Aziz and Darren, is that the rates will maybe proliferate, but what we'll see is the flows will go to certain institutions. So I think what you'll see is, and whether that's sort of regionally or in country, I think you will then see a shift in the competitive landscape, and that then may shift to different currency. But I think having lived in Europe and seen Swiss, I think everybody remembers sort of Swiss franc mortgages in Hungary or Australia have not been a happy outcome. So I think taking cross-currency risk is difficult, but I think it will be much more around potentially pan-regional players, actors, as opposed to rates, who will see the flows and understand the trading ecosystems and understand these bumps in rates or technical factors. But certainly we're seeing that with, there are clear market leaders in these rates, and they are picking up market share, and that should also lead to greater profitability.
And move on eventually to the liquidity thing we were trying to solve earlier. Thank you very much. We've run out of time. I think that was a very useful tour of the horizon. It's still a very complicated area. Lots of things still remain to be resolved, but hopefully we've flushed out the key issues that still need thinking about. So I thank you very much indeed. Anyone listening would like to get in touch directly with the panelists, ask them more questions, please do that. Darren, Simon, Aziz, thank you very much for this discussion today. We greatly appreciate your time, and thank you to the audience for listening and sending in some excellent questions. Thank you very much, and have a good evening in Asia. Goodbye.